What's going on? I am excited about bringing you some information that's going to help you get your deal funded. Okay, there's been a lot of questions about how this works, and we're getting ready to go through it. My name is Corey Boatwright. I am the founder of Real Estate Investing Profits, and I've got Mr. Mike Zlotnick on the phone with us. He is in charge of Tempo Funding from the TF Management Group. Mike, you there?
I am.
How are you
Hi,
doing today,
Corey.
man?
I'm great. How about you?
I'm doing phenomenal. I'm doing phenomenal. And I appreciate you putting together some information because people need to know this information about how to get their deal funded. And I know this is an area that you has been specializing in for I don't know how many years you've been in lending now.
Since 2009, so make it full 6 years plus.
Right. And I know that you and I have done quite a lot of business together, well over $1 million. And this is something that people need to know, but it's something that they get confused about. And so, can we go through and just make sure that people understand very simply on what's a good deal, what's a bad deal, right? And before they submit their application for funding, that it kind of lines up with that criteria. Can we just go through that and start showing them some examples of a good and bad deal, Mike?
Sure. Thanks again for having me on this video. Appreciate the opportunity. And let me jump straight to the presentation. So the disclaimer, we're not trying to sell you anything. This is for education purposes only. A couple of words about us. We are a private lender. We do specialize in bridge funding. We fund residential, typically residential, but we do some commercial, small commercial and multifamily deals too. Our focus are short duration bridge loans for fix and flip projects or fix and refi projects. So we provide short-term capital to help with acquisition, to refinancing, or to resale. We do mostly debt finance, but we do some equity funding as well, some JVs also. I started in 2009 in this business, and I do have over 15 years of real estate investment experience, owning properties, some in Florida, some in Brooklyn, New York. We've done over 700 transactions, well over 100 million in volume, and I co-manage 3 mortgage pool funds. Mortgage pool fund is just an investment vehicle for investors and for borrowers. It's a lending source. So let me continue. Okay, let me talk about some deals. So this is the most important element for you to be able to get a deal funded. The deal has to make sense.
Right.
So I'll give you some examples of what is a bad deal, what is a good deal, and what is an improved deal.
Okay.
A bad deal is when you are paying too much for the property, you're spending too much money on the rehab, and at the end of the day, when you resell it, you're not going to wind up with much profit. In some cases, you might even lose money.
But some people
So
think that might be a good deal just because they can get it for a little bit under what the R the after repair value is. But these are the specific kind of percentages that you're looking to kind of target for funding. Now this is a bad deal, so you're giving us an example of a bad deal right now.
that's correct. Ignore the picture. I chose one of those interesting pictures. This could be $1 million house, just so the picture and the dollar values don't match here.
Okay.
Let me talk about the concept itself.
Okay.
So let's say you negotiated a deal to be able to purchase it at $300,000, and then you went through rehab estimation with a couple of contractors and told you it's going to be $50,000 most likely. For one, you should always buffer that number. But just for the sake of the argument, let's assume the number I'm showing you is an average expected cost over rehab.
Right.
And you've gone through your comps, and you determine the after repair value is $420,000.
And is that pretty common that you see 10 to 20% of the purchase price being the rehab?
It depends. The bigger the rehab budget, in the scope, obviously, the higher the risk. So if you're involved with carpet and paint project where you're spending just a little bit of money, maybe 5% of the purchase price, you are in a lower risk. When you spend over 10% of the purchase price, sometimes 20%, it's a significant project, and your profit should be bigger on those projects because you're taking more risk.
Okay, so let's look at this. So 300,000 purchase price, rehab 50,000. So there's 350,000, but the ARV that someone can actually turn around and resell this thing for, or quote flip it, is $420,000. So you're showing the purchase and the rehab divided by the ARV equals 83.33%.
That's right. It is well above 80%.
So essentially, Mike, on this, just so everyone understands, it's 300,000 plus 50, so there's 350,000 divided by 420,000 equals 83.33%. That number needs to be under 75% in order for this to be a moneymaker. Is that kind of what you're saying?
Exactly. That's my rule of thumb. I like to use 75% or better.
Okay.
If you're trying to get a great deal, you want to be under 70%.
Now, what is this requested loan 315 number? Where does that number come from?
That number is essentially a max. So in today's environment, some of the lenders will go up to 75% of after repair value. So 315,000 is 75% of 420,000.
Gotcha.
So it's a max practical rehab loan that you can request. In this particular case, you're probably not going to get it because the deal doesn't make sense.
This is perfect. So this is really simple to understand. So basically, someone has a deal right now. They're looking at getting funded. All they need to do, if it's a fix and flip kind of transaction here, is they take the purchase price plus the rehab, right? And then they divide that by the ARV. And if that number is over 75%, and actually preferably 70%, so somewhere between 70 and 75%, if it's over that, that is a bad deal. You're not interested in doing that deal. One, it's risky for you, but two, it's not going to make money for the investor, correct?
That's right. So our goal is not to fund the deal. Our goal is to make the investor successful at their deal. So
Sure.
The first thing we do is we look at the deal, and if the deal doesn't make sense, we don't want to fund it because we don't want to wind up in a situation where investor is unhappy, they're losing money, and so on.
Makes perfect sense, Mike. Got it.
Yeah, so this is an example of a bad deal. Let's continue going forward. We'll show a good deal and we'll show an improved deal, and we can talk a little bit more about the formula.
Perfect.
By the way, the 75% is not written in stone. It is an approximate number. It is somewhat of a function of the scope of the rehab. If the rehab is very, very, very light, you could go a little bit higher. If the rehab is heavy, then you should be lower on that purchase plus rehab divided by after repair value.
More rehab needs to be lower on your LTV. Higher, less rehab can be in the higher of the LTV.
You can be somewhat above 75% on a very light rehab deals.
And especially if it's on the East or West Coast, right? A lot of these Midwest deals are probably landing in that 70 to 75% number. But I would think probably on East Coast and West Coast, the wholesale market out there is actually, closer to 80, maybe even 85% sometimes. But you're only going to loan that type of money if it's very light rehab, right?
Corey, you brought up a great point. In today's very competitive environment, especially in California, people are going above 80%, but they're taking too much risk, in my opinion.
Yes.
I'm not saying you can't do it, but you have to be a very, very sharp rehabber who can do the project.
So there's no way that you're going to probably do that deal with someone that just started doing investing. You're going to only work on something maybe higher than the 75% number if it's just a great deal. Someone just kind of stumbled upon a great deal, and they've done deals before. They're not just a newbie investor that's just came out of a seminar or whatever. They've done some deals. They've got some longevity behind them, so you have a little bit more confidence in loaning that money. And they have confidence that they can get it done.
That's right.
Okay, makes sense.
Right.
Okay, great.
Let's move on to a good deal. So you can see an example of a good deal, and you can kind of see the comparison.
Perfect. Tracking perfect here.
Very good. So the next example is a good deal. Again, the picture doesn't correlate to the house. So the purchase is again 300,000. but the rehab is much lighter. It's a $20,000 rehab, and purchase and rehab come up to be 300 plus 20, 320,000.
Yep.
And in this example, I'm using an after repair value of 470,000. Again, the numbers here are samples. There's markets where the number is going to be 3 times smaller, and there are markets where the number is going to be 3 times bigger.
Okay.
But conceptually, I want to relate the point. So here, purchase plus rehab, 320 divided by after repair value of 470 equals to 68%. It is a strong deal. If you're below 70%, you have ton of buffer space for cost overruns and longer time. So with this kind of ratio, you're likely to have a very solid moneymaker on your hands.
Okay.
Now, as far as the requested loan, I came up with a number of 290,000, which is about 90% of the cost basis. It's just a typical loan. So an example of a deal where the borrower brings in 30,000 and the lender brings in 290,000. The overall loan to value, 290 divided by 470 is 61%. So the lender is happy, the borrower is happy, the lender is going to get pretty decent pricing. The borrower is going to get pretty decent pricing from the lender. The deal is rock solid any way you look at it. So this is an example of a good deal. You'll make money on a deal like that. Again, stay below 70%, and you have a high probability of a success.
Okay, so let's walk it through one more time just to make sure. $300,000 purchase price, the same deal as the bad deal before, but now the rehab is half the price. So now it's 300,000 plus 20,000, 320,000, and our ARV now is actually higher too on this one. So the ARV is 470. So if you take 300,000 plus 20,000, that's 320,000. The purchase plus the rehab, divide it by the ARV, the after repair value, and that gives you 68% loan to value, correct?
That's right.
Okay, so
by the way,
where's the 290 number come from exactly here, Mike? Where's the 290 number come from?
Approximately, I'm saying that the lender will offer 90% loan to purchase price. So take 300,000, 90% of that is 270,000, plus the lender will offer rehab funds as well. So the total loan
plus the 20,000. So there's where your 290 comes in.
That's right.
I got you. Okay.
And again, the rehab number here, we're using an arbitrary number. The assumption is it is something that has been estimated by a professional contractor or a couple of contractors, and is assumed to be very realistic number. Not low, not high, just for the sake of the math. Mm-hmm. I'm using this number.
Right.
Yeah, don't take a $40,000 rehab and say, hey, I'll do it for 20. Don't do that. Obviously, the estimate has to be accurate, right, to make sure that you're computing the numbers correctly. Gotcha. The same thing when after repair value, be conservative. So 470,000 should be the price that you feel comfortable listing the property and getting offers within 30 days.
Gotcha.
So you should get a couple of opinions, not just an appraisal. In today's environment, my suggestion would be get multiple opinions from selling brokers in that area rather than some appraiser who might just give you a piece of paper saying, hey, it's 470,000.
Right.
I'm more interested
what properties are pending, what properties have active, right? Properties have sold.
Exactly.
Yes.
So the assumption here is 470,000 is a conservative number based on recent sales data.
Right. Okay. Okay, good.
Let's continue. Now the next slide is going to have a little bit more information, and I took the original bad deal that had was not fundable. It had too much risk in it, and I'm talking about a couple of improvements in the deal, and this is something that's going to greatly enhance the deal.
Okay.
So specifically, original purchase price was $300,000, and let's assume here that the project sponsor, the borrower who is doing the project, came back to the seller and said, look, you got a lot of repairs. And they came back with a dirty laundry list of problems and negotiated $30,000 discount with the seller.
Okay, so now they're at $270,000 on the purchase price.
Exactly. That's your technique number one. No matter what you're buying, you should always make an attempt to renegotiate the price coming back with a list of repairs even after you sign the contract. It's one of the strongest ways to improve your deal.
I agree.
So,
Yep.
so the purchase here is realistically 270,000. The 30,000 can come in a couple of forms. One is a price reduction. Two, it actually can be a seller's credit to the buyer for repairs, which is often better than the discount. But one way or the other, it's the same $30,000 discount.
Okay.
The original rehab was 50,000. So here I'm using an example to do more, not less. Sometimes you're better off cutting the rehab scope, depending on the type of property you're doing. If you're doing a $100,000 property and you're planning to do a $30,000 kitchen, you're probably overdoing it. But if you're doing $300,000 property, doing nicer finishes and adding square footage can suddenly increase the value significantly.
And I would say 10% for a kitchen alone for a rehab is it's pretty pricey.
Yeah, I'm not saying it's 30,000 in
10%
for a kitchen
of the
in this
purchase
particular
price.
case, but I'm just saying that in general, let's say you had a $50,000 budget, which is significant, which means
Right.
you're probably doing a lot of work.
Right.
And in this particular case, I'm using an example where you would enhance the scope, not reduce it. So you take your $50,000 budget, and then you speak with an architect, and you look at this property, and let's just say you could add 400 square feet approximately to the property,
Okay.
maybe 500 square feet, and then you use that square footage and you add one more bedroom, and you add a bathroom, a small. So the consequence of this is you're going to enhance the value significantly. Often an extra bedroom and a bathroom, an extra square footage, can take an after repair value up quite a bit.
Sure.
So in this particular case, you're increasing the after repair value of 420,000 to an enhanced after repair value with the additional square footage to 520,000. The numbers are very realistic. You're basically spending $30,000 more on the rehab,
Mm-hmm.
and you save that money through the better negotiation. But you enhance the value by 100,000. It's a great investment of capital. Put in 30, increase the value by 100.
Sure.
So this is something that you can always consider.
Yeah, most people don't think about doing this because they see the property for what it is and they think, okay, that's all I'm going to get out of it. But they don't consider what you just said. Is there a place? Can I add a bedroom and a bath? Can I add some more square footage on it? And what's my dollar per square footage? And many places around the country, it's $200, $300 a square foot or more, depending on the property you're dealing with. I'd say more in the Midwest, it's going to be under $100 a square foot. But on the East and West Coast, $200, $300, $400 a square foot is pretty realistic.
I mean, it depends, right? It depends on what kind of square footage you're adding.
Sure.
In some cases, when you're doing a serious rehab, you're going to move the walls. It's not a massive expense. Again, depending on it can be a couple $100 a foot, but I've seen people doing it for half the price, and if they already got the project estimated, the same contractor may be willing to take a much smaller profit on that extra square footage because they already got the project, and they'll give you a good price on the addition.
Well, maybe not even, maybe you don't increase it 100,000, maybe you increase it 50,000, right? I mean, even at 50,000, it gives you a lot more options whenever you're doing your lending.
That's right. So I kind of wanted to give this as an example to get people thinking about when they're doing a project, how can they enhance the value? And one of the enhancement is adding square footage and adding an extra bathroom. It depends on the house configuration. So if you're taking a small house with a 3-1 and you make it into 3-2, you can increase the value quite significantly.
Right. So the only difference on this is the 420 for the purchase price at the 83 percentage number, which is not a good deal. At the enhanced, the same deal. If you could get some of the discounts negotiated or maybe add square footage, the same exact deal, which the same exact property, you could bring down to 67.3% loan to value, and it makes it a good deal.
Yeah, and the beauty here is smart negotiation gave you the extra 30,000, so you got the same 30,000 through a discount on the price.
Right.
Now, if you couldn't get the 30,000 discount, maybe you can get 10, and the deal might still be plausible.
Right.
But again, I'm trying to contrast and show a really good deal and a really bad deal.
Right.
So in this particular case, in this example, $30,000 discount, all that money invested into additional enhanced rehab winds up increasing the value. So now you're talking about the cost basis is 270,000 plus 80,000, 350,000. You divide that by 520,000, and that's 67%, and that's a strong number.
And so now you've got funding 90% of the purchase price, okay? And then
That's right.
you say on here, do rehab holdback for 80,000. Can you explain the rehab holdback?
So a lot of lenders in today's environment will give you anywhere between 80 to 100% of the rehab funds, depending on the lender. But what they do is they don't disperse you the money up front. They disperse it on a draw schedule with progress on the rehab.
Gotcha.
So you do need to have some capital besides the 10% down to start the rehab.
Right.
And make progress to the point where the lender will disperse funds, and then you continue. And every time there is a disbursement, there's a quick inspection, and the progress is good, you get the disbursement check or a wire.
Gotcha. Okay.
All right, let's continue. So opportunities to improve each deal. I'm just going to mention these categories. Each of these categories is a significant opportunity for you to improve your deal. I mean, this can be a gold mine if you do this correctly.
Right.
So number one is always renegotiate the price. After you sign the contract, you come in to inspect the property, and you come up with a list of problems, and you always make them worse. And you come back to the seller and you say, hey, this is bigger rehab than I thought. Inspection failed, this and that. I'd like to get a discount. And then you ask for a big discount, and seller winds up in an interesting position. They either lose you as a buyer or they got to give you a discount.
Right.
And quite often they will give you a discount. Not guaranteed, but the chances are you'll be able to negotiate something.
Right.
Another great opportunity is improving rehab. So you can scale it up. The example on a previous page is scaling it up. You're adding square footage, you're adding a bathroom or a bedroom.
Right.
Or you can scale it down. You could look at the rehab. We actually just did a property like this in Jacksonville, Florida. We'll look at a full rehab, which was about $40,000. And we decided that instead of flipping the property, we're going to keep the property.
Okay.
And for a rental rehab, we cut it down to $20,000 because we basically got rid of all super nice finishes. Now, it does cut the value of the property somewhat, but the benefit is for a rental kind of a buyer, it doesn't need to be super high-end.
Right.
So depending on the kind of a market and the dollar price range, by scaling it down, you can save significantly on the rehab cost, but the value reduction is only moderate.
Okay.
So you could also, we have one project right now in Miami where the property is going through rezoning. So the way to enhance the value is instead of rehabbing the property, the borrower has gone to the zoning board and they're able to change it from 2-family to 6-family. That alone is enhancing the values quite significantly. So this particular case, he's not even going to build the property. He's going to complete rezoning and then sell it to another rehabber.
Gotcha.
For a significantly higher dollar amount because they enhance the value of the land.
Gotcha. Okay.
You can enhance the value through smart marketing. Now, this is a discussion of its own. But what I wanted to mention here is a lot of people overestimate the value of the property. They put it in the market and they sit on it.
Sure.
So all I'm going to mention is that if you are very good at listing the property below the market, getting offers, and then lifting them up. So there's a concept of listing the property at a floor price, not the ceiling, but the floor, getting a lot of exposure, getting offers, and then negotiating them up. Mm-hmm. You could actually get more money through this kind of marketing than if you listed high and you waited for the for somebody to come up to that price.
Right.
So this is one example. Other examples, you could do clever open houses, you could do social media. Any of the good marketing can enhance the value because often the price is an exposure. So if you got the house exposed to the right buyers, you may be able to get a better price. So I'm just using this as a category. Another very important opportunity is project time. So I see too many people spend way too much time on a project, and they could probably shrink the time in half if they plan better. I'm going
Right.
to give you some very, very simple example. You buy a property and there is a tenant in the property right now. They promise to move out. You buy the property, they don't. You have to evict. I've seen it multiple times. Very, very basic. Make sure you close. Property is empty at closing. Other ways to reduce time is to make sure if the work requires permits. Sometimes you have to apply right away. You got to have the right connections, and permitted time could be significantly reduced by spending a couple of bucks, getting an expediter, and they're able to get these permits done faster.
Makes sense.
Another way to do it, you can motivate a contractor with a contract. Hey, if you finish this project in 3 weeks, here's a $1,000 bonus instead of finishing the project in 6 weeks. Contractors play the
That
game.
helps.
They have multiple
Yeah,
projects.
that helps a lot. A lot of people don't realize that in incentivizing the contractor to give them to actually get the deal faster, it that can actually be great.
Right, so there's opportunities there.
Yep.
Another interesting opportunity to improve your deal is instead of buying the property with hard money with funding from us, you could get financing from the seller. I've seen that happening, or it can be sold subject to, where you buy a property from the seller and you assume the mortgage.
Right.
By doing that, instead of getting a fresh mortgage, spending closing costs, you just take over existing mortgage, just bring in rehab funds, and do a project that way. There are
Right.
opportunities in that space, significant opportunities. So, furthermore, there's an opportunity to finance a deal smartly. In other words, when you are buying a property, typically going to a hard money lender and you're trying to borrow a lot of money from a one lien. Sometimes you're better off getting a first lien and a second lien. Sometimes you can find an equity partner or a JV partner, and instead of borrowing the money, you will get the deal financed with an equity partner who will give you the capital, not going to charge you points on interest, but instead take a profit share.
Right.
So there's a way to fund the deal with lower level of risk for you. One important notion to keep in mind, one of the most important concepts, when you are trying to improve a deal and the deal is not good to start with and you can't improve it, be ready to walk away.
Absolutely.
You
Well,
know in your head.
that's a great point. Yep. Don't
Yeah,
be
I just want
so
to say
don't be
that,
so committed to the property if it's a bad deal that just because you found it and it's a potential good deal that you're going to get hurt because you just want to figure out a way to make it work. I'm all for being creative, figure out a way to make it work. But bottom line, if you cannot get it under that loan to value number, it's not going to work, and you're going to lose money, and it's going to be too risky for you to want to lend on, or anyone to lend on it.
that's right.
Right. Okay.
You will negotiate from a position of power when you're ready to walk away.
Okay.
One of the biggest mistakes I see in today's market, when the inventory is scarce, people get too motivated to go buy a deal just because they don't have other better deals.
Right.
And that's the recipe for disaster. So you better do no deals than a bad deal at
Right.
all. Right? So it's very basic stuff, but be prepared. If the deal doesn't meet your requirements, if you don't feel comfortable, not enough spread, walk away.
Walk away. Yep.
And by walking away, sometimes you'll motivate the seller. They'll come back and say, "Oh, wait a minute, I'll actually give you a discount."
Yes.
So
True.
it's part of negotiation tactics.
It is.
Just get up and walk away. And be very conservative in your estimates of cost and time and after repair value. I've seen a lot of
I
mistakes
typically
made
think
in
if
that
it's
area.
going to take 60 days, I always tell myself it's going to take 90. I always add
Exactly.
another month of things that could go wrong, right? And so if you think it's going to be a 30-day deal, tell yourself it's going to be 60, right? Is that what you're kind of saying?
Yeah, exactly.
Okay.
Exactly. I mean, 50% time buffer is very significant. If you're planning to say 3 months instead of 2, it's a very significant buffer.
Yes.
But it's a good way to do it. For most rehabs, I don't recommend people getting involved with big rehabs unless you are a specialist rehabber and you have experience.
I agree with that.
So
Yes.
the specific example would be take a light rehab where you think it's going to take you 2 weeks, and then you could project it to take 3 weeks. That is a very reasonable buffering.
I agree.
And then on a cost basis, look, on a light rehab, when you have $10,000 rehab, you could buffer 5,000 to 15,000, right? The 5,000 is not a big deal, but you can discover something unexpected.
Right.
On a $20,000 rehab, probably the same $5,000 buffer will do. It's 20% buffer is a good buffer. In some cases, again, small rehab, you should be a little bit high as a percentage because you're just
That's
doing
good.
so little work.
Yeah,
It can
I
be
saw you
something
say 25%. We don't do, a lot of fix and flips. We do mostly wholesaling, but as a lot of my students do a lot of fix and flips. You and I both know a lot of fix and flippers, and I think using 20 to 25% number for a buffer is really wise.
Yeah, I agree.
Yeah.
And on after repair value, this is where I see a lot of mistakes today, especially folks that have limited experience. And I can tell you, number one mistake, they order an appraisal and then they believe that the appraised value is going to be the value they're going to sell.
Right.
It is an area of danger. Don't use an opinion of an appraiser only as the foundation for the value.
I look at the pending, I look at the active, and look at the sold.
That's right. Look at the current data, current sales, current listings, and ask a couple of brokers for an opinion. Tell them I'm about to buy this house and I'm going to do the rehab. What do you think I can sell it for if we finish, in 3 months? What would you list it for to be able to sell it within 30 days?
Now this changes. I mean, obviously for your market. So, and we don't want to go into too much of this because it's not the point of this particular training, but on the East and West Coast, particularly, mostly on the West Coast, you might actually get more money than what you list a property for. I mean, there's properties right now in, Cupertino, California, and San Bernardino. I mean, all these different places in California that you list a property, it's going to be sold 7 to 10 days, and it might be sold for more than what you list it for, right?
That's
but
right.
in the Midwest, where I'm in Oklahoma, Texas, Alabama, these areas in the Midwest, I'm seeing that properties actually are going to be about 10% lower than what you probably list it for, because it's going to be time on the market there for a little bit. Then it's also going to be someone coming in not making you a full price offer unless it's just an absolute deal that they just love to have, and you're probably not going to get the highest number. Now, you come in and you want to make your house be the most beautiful, best house on the block, you're probably going to get a pretty close to what you have it listed for. But a good conservative idea that I think is smart to follow is it's going to be about 10% lower than what you think you're going to sell it for on the Midwest. On the West Coast, East and West Coast, particularly more on the West Coast, you might actually get more than what you list it for.
Yeah, so I agree with you, Corey. Every market is local.
It's different, right?
And I'm going to go back to that statement. There are seasonal trends. I am in New York, and when the weather gets cold in Midwest and any part of the country that is weather sensitive, you're definitely going to get seasonal trends, and the winter sales are going to be weaker price than spring and summer sales. So
Right.
definitely adjust for the seasonal trend, plus know your own market. You could start with a great listing price in Texas, right? If you list it low enough, you can get offers immediately at the listing price or above.
Right.
So, but I'm just saying that as you investigate the likely resale price before you do the project and investigate it well, and don't just rely on one appraisal.
True.
Get as much information as you can, get multiple broker opinions, and ask them. The right question is to ask, if I give you the listing, how do we get a strong offer within 30 days? At what price do we have to list to get the offer at around the listing price within 30 days?
I agree.
You don't want it to sit in the market.
I agree.
All right, let's continue. So funding basics. I kind of wanted to talk a little bit about this. So when a lender looks at a deal, whether they want to fund it or not, the number one thing they look at, does the deal make sense? This is back to the formula we talked about, 75% purchase plus rehab divided by after repair value. Is it less than 75%? That's the question we ask the moment we look at a deal.
Right.
Now, this number varies. In California, in a very competitive market, plenty of people are buying this at 77, 78, 80%, sometimes even over 80% on light rehabs. But it's a danger zone. And we see people losing money on those deals if they miss on the after repair value, if the rehab takes longer, or the rehab budget blows up. they suddenly can wind up in a money-losing proposition. So
Right.
the second thing that the lender looks at is do you have a down payment? And there's a term used in the industry, skin in the game. In other words, how much money you bring into the project. So in today's environment, typically having 10% down is a minimum that you probably need to have to be able to get the deal considered for funding. The lenders that will do the deals with 10% down, the classic requirement is 20%. So if you have 20% down, there are a lot of options for funding. If you don't have 20% down, you have fewer options and the money is more expensive, but it is possible to get the right deal funded at the right ratio. The other important question you should always keep in mind, do you have enough funds for the project? Do you have enough funds for a down
What does that
payment?
mean? You have funds for the project. How explain that a little bit.
You need to build a basic budget for your project. So the down payment plus any kind of a closing cost that you're going to have, plus carry cost. If you have to make payments to your lender, some lenders will allow you a balloon. We allow balloons sometimes, but in some cases it's a monthly payment, interest only. So you need to budget enough money to be able to make those payments.
Explain a balloon real quick, Mike.
Balloon is when you have a loan for 6 months and your payments are deferred for 6 months, so you're not making any monthly payments.
Gotcha.
They just accrue and they're due and payable in 6 months. So that's an example of a balloon versus monthly payments.
Typically, though, you're doing most of your deals in monthly payments, correct?
That's right.
Okay.
So we were doing more deals with monthly payments than not monthly payments, but in some cases when the spread is strong and the borrower is low on cash, we may be able to do the deal. It is a more expensive proposition. Typical lenders charge the rate 2 or 3% higher for a balloon versus non-balloon. But again, it's a liquidity issue. If you have a great deal, low liquidity, you bring us a deal, you have 10% down, may be able to fund it.
Okay. So and the payment amount is going to be between what, 10 and 15%?
Right. So if you are thinking about, I mean, having yes, 10 to 15%, having again 10% down, another 10% to cover the payments and closing costs, will usually suffice. So if you have only 20% of the deal, you may be able to bring 10% down and 10% to cover the payments.
Cover the payments. Got it. Okay.
And the other thing you got to budget for is a rehab funds. If a lender will give you $20,000 towards the rehab, they're not going to give you $20,000 at closing.
Gotcha.
You may need to have $10,000 additional to be able to start the rehab. The lender will inspect the property and then disperse you $10,000 that you spend on the project.
Gotcha.
So when you're budgeting, you should have the down payment, monthly payment if you have to make them, any kind of closing cost, and then the rehab, the initial budget for the rehab.
Got it.
Too many people miss it. They just think, hey, I got 10% down, I want to start the project. Okay, wonderful. We're going to come to a closing table, but you don't have any funds to start the rehab. I mean, it's an issue. So you just make sure that you understand, you project your project really well, and you have sufficient budget. If you're short on funds, come to the lender. Don't hide anything. And say, hey, I only got 10% down. I don't have rehab funds. Can you advance me a little bit of rehab funds? And some lenders might consider doing it.
Okay.
The other most important consideration is the exit strategy. That's the first question, actually. How are you planning to get out of the deal? And there are a couple of really basic exit strategies. Number one is resell the property. But the question is not just how are you going to resell the property, but how long is it going to take? What price are you going to list it at? What do you think your likely resale price? So it is a resale, but when, how much, and what contingencies?
Right.
Another exit strategy could be refinancing. So if you are buying a project for a long term and you want to hold it, there are plenty of lenders who specialize in long-term, multi-year financing, and we actually have relationships with lenders who do provide the capital for long-term holds. But we're providing bridge capital to get the property to a full fair market value.
Now, when you say long-term hold, that means between 6 months and a year. Would you consider that a long-term hold?
No, I will consider long-term hold is something that you want to buy a property for 5 years or more.
Okay, so from what you're saying then on whenever someone works with you, you're typically going to, have a kind of ideal number of 90 to 120 days of where you want to be in and out of that deal. Would that be accurate?
That's totally correct.
Okay.
So
But
our
you'll but
goal is
you'll go up to 6 months to 12 months if it's just a really rock solid deal, right? They have money down, making monthly payments, they have budget, they got money for things, and you feel real comfortable with the deal. Is that accurate too?
mostly yes. So our target time is 4 to 6 months.
6
Once the deal it looks like a massive rehab, and it's going to take 12 months, we'll consider the deal, but it's not our typical deal. We
Okay.
like the deals that you
Long
can
term hold
confidently
then.
get out within 6 months.
Okay, so long-term hold is 3 to 5 years, and that's not someone that you're gonna. That's not someone that's not a deal that you want to do. If someone's looking for a long-term hold, then that's a play where they will work with you at first, get the deal done, take the deal down, basically working with you, and then they will refinance or take it into another direction for a long-term hold. Correct?
That's exactly correct. So
Okay.
we work with a lot of people where they will use us as a bridge funder for a fix to buy and to fix the property,
Yep.
and then they go for refi. And we actually have a relationship with a lot of refi lenders who will happily refi a property once it's been refixed, repaired, and then stabilize with a tenant. Rent it out. You have a tenant. Now they look at the property as a long-term asset that they can fund based on the cash flow of the deal.
And some of those deals, not to go into this too much, but on the refi percentage, what are they looking for on long term? So I come to you, I get it under 75% LTV. It's a good deal. We're rocking along. I get it. I'm ready to get out of this deal in 4 months, let's just say. And that's something that I want to hold. I want to actually do a long term hold on it. What are you looking at if I come to you and say, hey, Mike, do you know anybody that will do a long term hold 3 to 5 years for me on this deal? What percentage are they looking at now that the property's beautiful, rehabbed, and ready to go?
So typically, in today's environment, they will go in theory up to 75% of the fair market value. In practice, I see it much likely to be 65 to 70%.
So they're going to
So
go 75% of ARV, basically.
that's right, but it is a theoretical number. More practical number that I see refinancing happening in the 65 to 70% range. They look at a couple of things. They look for one is at that LTV. The second thing they look at is what they call the debt service coverage ratio. It's
Right.
basically how much cash flow the property generating. Is there enough income to pay taxes, insurance, repairs, consider potential vacancy, and then the cash left over will be sufficient to pay the mortgage payment and
Right.
leave some money over that.
This is
So
really
those,
interesting that you're saying this, though, because some people might say, well, that's 75%. What's the difference? Well, the difference is now it's 75% of ARV, right?
that's
Before, for you, it's purchase price plus rehab divided by the ARV needs to be under 75%. When it's already
that's right.
ready to go, it's a beautiful house. Now they're looking at just straight what's the ARV, right? So one of these examples is like 470,000, right? And they're going to loan 75% of the 470,000, which if I got my calculator here on that example that we have, times 75%, 470,000 times 70%, 329,000. So for a long-term hold, they will loan you 320,000.
That's right. And I wanted to make the point, most of the projects we like to fund, we like to limit it to 70% on our loan side. That's kind of our practical max. The reason for this, if you try to refi, you're not going to get 75% of that fair market value most of the time. So when you are planning a refi, especially if you want a refi where you're not bringing any cash to the closing table, you definitely need to have your deal, purchase and rehab, be below 75%, but you'll still wind up having some sort of a skin in the game on the refi side. So exit strategy through refi is something worth considering, but you'll probably wind up keeping some of your own capital in the deal. So you got to be prepared, and use 65 to 70% of the fair market value as a realistic loan on the refi transaction.
Gotcha.
It's almost similar on the refi and the bridge loan for the fix and kind of refi stage of the project. The amounts are very, very similar. Lenders on the refi side are just using a fair market value, while the lenders on the
Well, and there's something to say about this is an investment property, right? If you're going to live in this house, and you're gonna be a property you're gonna be, you're gonna live in, it's gonna be, you can sometimes get 90%, or more of the ARV.
Yeah, my disclaimer is we do not fund any owner-occupied properties.
Yeah.
If you want to buy a property without money, we're not going to be able to help you, unfortunately.
Right. Yeah. All investor property.
Yeah, it has to be an investment property. In the owner-occupied space, once the property has been repaired completely, you can finance it through, Fannie Mae backed, Freddie Mac backed, FHA, USDA, VA. Those products sometimes will give you over 100%, but it's just really something that refinancing using those funds is possible.
Right.
But it's a much more difficult underwriting. I have to say that Fannie Mae and Freddie Mac, they have a product where you could get up to 10 investment properties under their programs, but refinancing is complicated.
Right.
Also, they have a concept of seasoning. In other words, if you bought the property cheap and you fixed it up, they'll probably want to see 12 months seasoning before they can refi you under their guidelines.
Yeah, how long you've owned it. Okay, that sounds good, Mike. What's the way that what's your next slide there?
Oh, the next slide. So our approach to business. We start by analyzing deals, then we look how to improve deals, and then we fund deals. So if you have a deal, feel free to run by us. We'll give you feedback. Kind of our job number one is to help you make sure the deal is solid from the numbers perspective, and you're able to improve it. Often you'll come back and do something. Any attempt to improve can only make things better than worse. Our kind of mission is to match great opportunities with smart capital. So sometimes we'll be able to match your deal with the right investor. It could be one of our funds or could be one of the IRA investors.
Great.
And the key phrase that I like to use is when you're doing a deal, you need to understand all the potential outcomes, kind of the good, the bad, and the ugly.
Right.
And look at the ugly scenario. If the deal is still profitable in a difficult scenario, then you got yourself a really good deal. That's it.
I love it. Okay. And this is the best way to get in touch with you. And you can go to realestateservant.com/get money now. If your purchase price plus rehab, okay, divided by your ARV is under, let's say, between 70 and 75%, probably a good opportunity for us to look at the deal. If it's not there yet, don't even worry about that, because it's too much of a risky deal to do, and you're not going to most likely make money on it unless it's just some strange home run deal that your area so well, and some private lender is willing to just give you money for nothing. Mike's looking at this in order to stay in business for as long as he has, to be able to do smart deals. And in order to do that, he's figured out the criteria that works. Okay. So just simply take your number, purchase price plus rehab, divide it by your ARV, and see where you are. Are you 80%? Are you 90%? Are you 60%? Right? If you're anywhere under 70, if you're between 70 and 75%, there's a good chance you have a good deal that we want to talk with you about, and we can do a deal together. I work with Mike personally on over $1 million in transactions. I send students over to him to work with him. He's in a mastermind with me. Mike and I have actually worked together in consulting together. So he is somebody that I explicitly trust, and which is important, because there's a lot of guys out there that may offer you a deal, but they haven't been in business as long as Mike. They haven't done what was the number, Mike? You said $100 million in loans, right? So $100 million in loans and funding.
700.
What's that?
Over 700 deals.
Over 700 deals, $100 million in loans, right? There's something to say about the guy that you're getting ready to go have brain surgery, right? And there's a guy that comes in the room and says, you know what? I'll do this deal for you for $10,000. Or the other guy that says, you know, I cannot do it for 10,000. I'll do it for, 25,000, but I'm the best there is. I'm the best there is. There's nobody else out there that's done it longer than I have, that has, done these type of deals, works with the people. I know the questions to ask. I want to work with the guy that is not necessarily the cheapest in this space, as someone that is the most reliable and the person I can trust. And I know that the deal is going to happen. I know he's going to, be able to make the deal not be risky, right? So he doesn't want to get involved with a risky deal. He wants you to have success. That's the most important thing. In order for that to happen, you have to match the criteria. So I appreciate, Mike, you taking the time to do this training. I think it's very important that anyone really looks at their deals right now if they're considering doing a hard money loan, essentially, through this. And the best way to get in touch with you is to email you, Mike at tempofunding.com, or call 917-806-5029. That's your office. But I would prefer that you go to realestateservant.com/get money now and submit your deal first, to make sure that if it's kind of fits within this criteria that we discussed. And then from there, if you have extra questions, you can get in touch with Mike from there. But if you walk through the deal at realestateservant.com/get money now, it asks you the questions, and it's very simple. Just walk through the deal, and it'll be as simple as possible for you. Do you have anything extra to add to that, Mike?
Yeah, I would, Corey, thank you again for having me here. I would greatly appreciate if you submit your deals or your requests through that website. The phone number you have is my direct number, and I would, again, greatly appreciate if you submitted the deal first. And if you're not getting a quick response from one of our team members, you can email me and just say, hey, I submitted the deal. Can you have somebody take a look? Just to be clear, we have a team here, and one of our folks will look at the deal and will get back to you. Feel free to talk to me directly. I don't mind, but I ask for you to respect my time, just like I would respect your time. Try to submit it to the website first. Let somebody analyze it on our site, get back to you, start working with them. I am available for you to speak. My job is to build relationships. I'm a people's person, so I would be happy to chat with you about your business and your opportunities. But individual deals will be working with our underwriter or team members directly, and I'll help you to get your deal to a funding stage. So thank you, Corey, very much. Appreciate the opportunity to be here.
Thanks, Mike. Appreciate it. Again, go to www.realestateservant.com/get money now and submit your deal if it kind of fits within this criteria. Thanks again, Mike. I appreciate you.
Thank you.
All right. Bye now. Remember, be a servant. Bye.